Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management, and I'm here each and every week to educate and inform on all things financial because after all, your money matters. And friends, we are officially in tax season. Now, I know for many people out there, you probably don't even consider this a season. You're like, Brad, why is this a season? And it is for many people, and for all of us, we have to go through it. And the tax season basically runs from January 1st to, we'll call it April 15th. And for many people, like I shared, not exactly the most fun time period. However, I'd like to share a little history on taxes and some facts and figures that I think will surprise you, as well as some helpful options that'll get us through this tax season unscathed. All right, let's get into it. Do you remember what year the United States permanently adopted an income tax? Most likely you don't. But I want to share some of this because I think looking backwards helps us look forwards a little bit sometimes. The federal income tax was actually made possible by the 16th Amendment to our Constitution, which was passed by Congress in 1909, and actually ratified by the states in 1913, which at that time, it basically authorized Congress to impose a federal income tax on U.S. citizens and corporations. Now, time out for a second. Before I move into some further data points here, it probably strikes you as somewhat strange that if we never had an income tax before, that we would actually ever adopt one and vote for one. You might be asking, why would anyone, any sane person, give up a portion of their income? And if you don't know me by now, I'm the person that usually takes a thread from a sweater and just keeps on pulling. So when I'm looking at these data points, I just keep digging. And I dug pretty deep on this one, and I realized when it comes to U.S. history, there's always some reasons behind it. And so when it comes to the 1913 and why we as citizens actually voted to have our income tax, this is the reason why. If you look at history prior to that time period of the income tax being put in place, government revenues were derived primarily from taxes, not on income, but on goods, import tariffs, and on products that were made abroad, and excise taxes on things like alcohol. I mean, talk about hitting the United States below the belt on that one. I mean, that type of revenue generation model actually hurt working class people and actually at that time benefited the rich. And this is exactly where we get into the notion in economics where we call a regressive tax design versus currently a progressive tax design. So right around the early 1900s, America's common man believed they were essentially shouldering the majority share of paying taxes. And so in 1913, they established an income tax, which would force, in their minds, the rich to pay their fair share. So then the 16th Amendment was put into law, and get this, 42 states voting for it, and only 6 voting against it. At that time, it was only 48 states in the Union. What I'm trying to say is that the 16th Amendment, which was our income tax we deal with every year between January through April 15th, was provided to us by the 16th Amendment with overwhelming support. Likely everyone watching and listening have never not known an income tax. I mean, unless you're over 115 years old or 120 years old, you have not known a tax. It's just been part of our life. It's been well over 100 years since the inception of it. And so it's important for us to contextualize that as we look to our planning. Now, a couple more interesting notes here. The U.S. tax code is composed of an estimated 4 million words. That's about 6 times as many words as there are in the Bible. And trust me, there's a lot less good in the tax code. But according to the U.S. Ways and Means Committee, it's estimated that Americans, people like you and me, each year collectively spend about $170 billion and 6 billion hours trying to comply with the tax code. Now, I don't know about you, but that's an incredible amount of time and money wasted, in my opinion. I mean, just think of all the wonderful things that could be done if our government redirected $170 billion of capital and 6 billion hours of labor in a more positive direction. Now, obviously, I talked a lot about that when it comes to government overspending and the budget deficit conversation, which, by the way, I covered in a recent video. You can check it out. It will give you some insight on really what's been going on in Congress around the budget deals and the raising of the debt ceiling and things like that. Now, this being said, one thing you should know is once you're in tax season, there are only a few things you can do still for the prior year. Essentially, everything we do from January 1st to December 31st of a given year is what you're doing essentially for the tax component when you file the year after. So for this year, right now, we're at everything we did, all of what we did in 2022 is really what we have going on into the tax season for this year. Before we talk about ending 2022 in the tax season that we're in right now, I want to share this, and I know many of you are going to listen, maybe even roll your eyes at me right now, but when it comes to tax planning in general, being that we're still in mid-February right now in 2023, now is the time to do some things for this year so that when we get into the next tax season, which is for tax year 2023, we're better prepared. This is why you hear the term tax planning. Most people think, wait a minute, I got all my forms in January, February, so it's basically just, I'm not really planning, I'm just doing. That's why tax planning from a financial advisor's perspective is so important. And let's talk about specifically 3 things that are really important as frame of reference when it comes to our taxes. Some of these will pertain to you, some of them won't, but there's 3 that I see with clients across the board that I wanted to share today on the show. The first thing I want to bring up, which is contributing or tax deductions specifically to tax advantage accounts. Now, for some, that's a 401k plan, that might be a simple IRA plan, a SEP IRA plan, maybe a deferred compensation plan. You have the ability to defer up to now for 2023, $22,500 if you're under the age of 50, and an additional catch-up of around $7,500, which gets you to $30,000 for 2023, mind you, for tax deduction purposes. Now, because we're in 2023 though, and we're filing for last year, before we get further here, for last year, the contribution limits were $20,500 for under 50. So for those of you that contributed all of last year, you'll see on your W-2, when you file it, when you give it to your tax preparer, you'll see your numbers as retirement plan contributions. And those are items you have to do. Those are an example of items you have to do before December 31st. So before we move on to number 2, in 2023, heading into next tax season, make sure you're talking to your advisor this tax season or your advisor about how much you should be contributing to your retirement accounts, finding out what your tax benefits are for the amount you're contributing and what additional tax benefits might be there. The things you do today are going to matter this time next year when you file for 2023's tax season. All right, number 2. For those of you out there with taxable accounts, let's say it's an individual account, a brokerage account, maybe a trust account or a joint account that has investments into it. Maybe if you lost money in your investments, you can actually benefit from that. And most of you probably know this, but I want to share some things. So here's the beauty of taxes. And many of you know, this is capital gains, a loss carry forward specifically. And last year, those of you with a lot of stocks and bonds and assets, you're not alone if those things went down a little bit, but you can take some sting out of those losses by what we do here for our clients at One Capital, for our clients with regards to tax loss harvesting. And if you have those accounts with us, as a client, you're listening here, we're doing this. It's called tax loss harvesting. And the strategy generally allows you to sell investments that are down, replace them with reasonably similar investments, and then use those losses to offset the realized investment gains. Now, obviously, in everything I'm sharing with you today, make sure you go through this with a tax advisor. Myself, our firm here, One Capital Management, we are not tax preparers or advisors. Because we're so involved with our clients, we speak very eloquently to taxes, but we're not going to file them. So this is where the coordination of your tax team comes into place. And speaking of tax losses, you actually do get, based on the current tax code, up to $3,000 of regular income each year as a carry loss forward. So make sure to discuss that with your advisor and your tax preparer as well. The end result, essentially, why I'm bringing this up, is that less of your money goes to taxes and more stays invested, working for you, which is a good thing. Now, unused losses, as I just mentioned, carry over to subsequent years, which is that whole carry loss forward thing. That's the $3,000. And the strategy can be somewhat complicated because there's some wash sale rules that may apply, which essentially basically means you can't sell most of the investments for a loss and then reinvest in the same or identical one within 31 days, or you'll lose the tax break. By the way, if I'm sharing something in point number 2 here, this is where advice comes in, as I've shared. So having a professional management do some tax loss harvesting for you, making sure you're working in coordination with your tax planner is of paramount importance here on items like this. And again, this is for brokerage accounts, joint accounts, trust accounts, self-investment, brokerage accounts, things like that, what we call after-tax investments. Now, my point number 2 here is looking into this year from last year is making sure that you take advantage of losses and you can, we call harvest them, right? That's why it's called tax loss harvesting. And in a year, more specifically, actually, why I want to bring this one up now on the show is in a year like last year, we're doing a lot of that work harvesting, loss harvesting for our clients by using those to offset other investments or similar ones, making sure we're able to use those for tax benefits, especially in a year where you have, a bear market and things are moving negative.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, that moves us into number 3 because it dovetails right on number 1, which was taking advantage of your tax-deferred accounts. Now, there's a time where you can consider Roth conversions as well, and I speak about this almost every year. Let me be very clear and caveat something here. Roth conversions are not for everybody. I know you can Google Roth right now and you can find umpteen different articles on this. And I've always shared as an advisor, that's one area where I kind of sit on the fence because I can see it from both sides. I really can. The whole play on Roth is we expect we're going to be in a higher tax bracket in the future, which I'm not disagreeing with, but it's also one of those things you want to work with your advisor and work with your CPA to make sure you're also harnessing as many benefits as you can today as well as for tomorrow. And when it comes to Roth in general, I'll share this. There's 2 C's that I talk about that get a lot of people confused. There's conversion and contribution. So one thing I want to be very clear about is Roth contributions have a limit. Every year, there's a limit to how much you can contribute to a Roth account. In terms of conversion, that's unlimited. You can convert as much as you want from a traditional IRA or a tax-deferred account to a Roth account. However, the amount you convert will be taxable. So this is where you want to play what I call the bracket game with your advisor to maximize the highest and the lowest tax bracket. And that's a really good window potentially for Roth conversion. But I get asked that a lot, but there's 2 C's and they're 2 very different C's, contribution versus conversion. So it's important to make sure you go through it. And it's a really cool thing to be able to do the bracket game with your tax preparer and find the bracket, the bracketology. It's basically kind of like what we're going to see in March Madness. I talk about this a lot in March. Typically, I'll probably bring this up on the show. And so when you think about your taxes, remember this, and everyone talks about it. No one wants to pay more than they have to. Well aware. Totally get it, right? And like I mentioned before, there's some stats on taxes going back over 100 years and why our country is even involved with it and this, that, and the other. But I think the frame of reference for taxes, we realize that for all of us watching and listening, we know it's been a fact of life. We're in that season. So the 3 items I wanted to share was taking advantage of your tax-deferred assets, making sure you're capitalizing on any harvest losses or capital gains environments, and then understanding how Roth might play into it for you with regards to contribution and conversion. Those are 3 key things that leads me into planning, tax planning, right? Remember that tax planning happens throughout the year. So we might be saying tax season is January 1st, April 15th, but the reality is tax planning season, which is the big season, is all year round because once December 31st comes around, most of the things you can do for taxes for the prior year are done. Now remember that no matter what happens to our tax rates in the future, we are in a marginal tax system. You're probably wondering why a financial advisor in particular, why an investment advisor like me talks so much about taxes, especially during tax season. And here's why. Because taxes have everything to do with investing. Taxes have a lot to do with planning. Now, there's probably 2 things as an advisor of nearly 2 decades now that I sit on the fence with, as I mentioned. The other one I mentioned is paying your house off because I can see it both ways. The other one is Roth, right? I can see both sides of that coin. And there really is an argument I have pro or con for either one. And I don't disagree or agree because you can line up a bunch of CPAs and a bunch of advisors. You're going to get like a bunch of different answers on that. And the notion of Roth is, again, that we think taxes are going to be a lot higher, significantly higher in retirement than they currently are now. Now, given our debt and where things are at, we're generally going to see, hopefully not, but we might be seeing a rise in taxes over time. But I don't know if it's going to be something where it's going to double. And I may be wrong on that. So just, someone can fact check me 20 years from now. But, I don't know if it's going to double. And I feel, if you look at history, we've never seen that in our history where all of a sudden we're paying 20%, the next year we're paying 40%. Because we're in a marginal progressive tax system, I think a lot of clients and a lot of prospects and people I speak to, they have this notion, it's almost like interest rates too, where it's like when something goes up, they just immediately it's going to double. Like when someone raises rates, they think, oh my gosh, my mortgage rate's going to double. I'm like, no, you're in a fixed rate. Same thing with taxes. It's like, okay, taxes go up and we think all of a sudden we're going to pay this insane amount more. And so remember, we're in a marginal tax bracket. And what does marginal mean? Marginal means there's a different amount per tiers. in each. Now, depending if you're filing single, filing jointly, and you can go through it real quickly. But the reality is there's different tiers. So a certain portion of your income would be taxed at 10%, 12%, 22%, and so on, right? So it's not just like the whole thing's taxed at X amount is what I'm trying to get at. So understanding the bracket game when it comes to that, I think is vitally important. So, it's always funny to me when I look at income and when I do this in my discovery meetings with clients, you look at gross income versus net income. And by the way, it's called gross income because it's disgusting what you pay in taxes, right? The gross is what you could keep and the net is what you actually keep. That's why it's gross. Anyways, the difference between your gross and your net is the reason why we all don't like paying taxes, because we'd rather have it in our pockets than going to someone else, especially Uncle Sam at this point. So really more than anything right now, as we head into taxes and getting our W-2s and 1099s and all that stuff that's coming in right now for you, now is the time when you're setting your meetings likely with your CPA, your tax preparer. And the idea with this show today is to bring up all of the things that I see for clients. And obviously, we're going to talk a little bit more when it comes to tax planning each week here as we are in tax season. So I'm going to bring this up a lot here on the Make Your Money Matter show. But remember, each tax person, each person's tax situation is different, and obviously with all the inflation adjustments that we have right now, they were big. I mean, even the contributions from last year, they're big. And so I think it's important that we talk about it this year. We're going to continue to talk about it here on the Make Your Money Matter show. And one last thing I want to share and put a bow on this conversation when we start the tax season discussions, 2023, as we all saw, brought a lot of inflation adjustments to tax brackets. So you're going to see some different taxable incomes for this year. And maybe a fourth point I'd add here at the end is to bring up some of these items, again, with your preparer this season, seeing how the 2023 limits have changed. It's good for you now as a start your planning for this year as when you file for next year. Take advantage of those. If you have it in your cash flow, take advantage of those contributions. It'll affect your overall investment return. It'll affect your overall, amount you're able to have at the time you choose to become retired or live financially free. But always remember, it's important to consider putting a plan together with enough flexibility to meet your financial goals for the current and future years. And as always, we want to consult with your tax advisor to construct that plan from a tax planning perspective. We here at One Capital Management will help our clients and work in concert with their tax advisors for their financial plan, making sure that this year and ensuing years are as well thought out and planned for as possible. Before we go today, if you found anything helpful and want to learn more, visit our website at onecapital.com. You can also call or text us. We want to help. There's no pressure here. We don't treat people like a number. We value our relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. You can follow us at Make Your Money Matter, where we're sharing great information on all of our social media platforms. And as I often say, if you enjoy the show, share with someone you like. And I guess if you don't like the show, share with someone you don't like. But until next time, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.